Imagine waking up tomorrow, grabbing your phone, and seeing headlines everywhere saying gold is collapsing as interest rates surge, investors panicking, markets moving fast, and suddenly everyone is asking the same question. Is gold losing its power? Or is this the biggest buying opportunity of the decade? Because right now, something very important is happening behind the scenes, something most people don't fully understand, and if you miss it, you might miss one of the biggest financial moves of your life. Now, before we go deeper, if you want to understand gold, markets, and money in a simple and powerful way, make sure you hit like and subscribe. Because on this channel, The Gold Report, we break down complex financial topics into stories you can actually use. And trust me, today's topic might completely change how you look at gold forever. So let's start with a simple idea. Interest rates and gold have a relationship, but it's not always as simple as rates go up, gold goes down. That's what most beginners think, but the real story is much deeper and much more interesting. Think of interest rates like gravity. When rates go higher, they pull money toward things that give returns, like bonds, savings accounts, or fixed income assets, because suddenly you can earn money just by holding cash or safe investments. Now imagine you're an investor, and the bank is offering you 5% return. Would you still hold gold, which doesn't give you any yield, no interest, no cash flow, just price movement? This is why, in general, when interest rates rise, gold faces pressure, because the opportunity cost of holding gold increases. In simple words, you're giving up guaranteed returns to hold something that just sits there. But here's where things get interesting. Because gold doesn't just react to interest rates, it reacts to real interest rates. And this is where most people get confused. Real interest rates are basically interest rates minus inflation. So if interest rates are 5%, but inflation is also 5%, your real return is actually zero. You're not really making money, you're just keeping up with rising prices. And in that kind of environment, gold becomes very powerful. Because gold is not just an investment, it's a store of value, a protection against losing purchasing power. So when real interest rates are low, or even negative, gold tends to rise, sometimes very strongly. Now let's turn this into a story. Imagine a time when central banks start increasing interest rates to fight inflation. Markets react, stocks become volatile, borrowing becomes expensive, and slowly, economic growth starts to slow down. Now at first, gold might drop because investors move toward higher yield assets. But then, something shifts. As the economy weakens, fear starts to grow, recession talks begin, and suddenly, investors are no longer chasing returns. They are chasing safety. And that's when gold comes back into the picture, sometimes even stronger than before. This is why, if you look at history, gold doesn't just move based on rate hikes, it moves based on expectations, emotions, and the bigger economic picture. Let's make this even simpler. There are 3 phases you need to understand. In the first phase, when rates are rising and the economy is still strong, gold often struggles because money is flowing toward yield. In the second phase, when rates are high but growth is slowing, uncertainty increases and gold starts to stabilize. And in the third phase, when the market expects rate cuts or a crisis hits, gold often rallies, sometimes very aggressively. This cycle is repeated many times, and those who understand it don't panic when gold falls. They prepare. Now, here's a question you should ask yourself. Are we in phase 1, 2, or 3 right now? Because the answer to that question can completely change your strategy. Right now, central banks around the world have been aggressively raising rates to control inflation, but inflation is still not fully under control, and at the same time, economic growth is slowing down, debt levels are rising, and global uncertainty is increasing. So what does that mean? It means we might be moving from phase 1 into phase 2, and possibly toward phase 3 in the future. And if that happens, gold could become one of the most important assets to watch. But wait, there's another layer to this story, something even bigger, the US dollar. Because gold and the dollar also have an inverse relationship. When interest rates rise, the dollar often becomes stronger, because global investors move money into US assets for better returns, and a stronger dollar usually puts pressure on gold. So now, gold is not just dealing with interest rates, it's also dealing with the strength of the dollar, and this creates a complex environment. But again, nothing is permanent in markets. If the economy weakens and the central bank starts cutting rates, the dollar can weaken. And that's when gold can shine even more. This is why smart investors don't look at just one factor. They look at the full picture: interest rates, inflation, economic growth, currency strength, and most importantly, market sentiment. Because at the end of the day, markets move on expectations, not just reality. Now imagine this scenario. Interest rates are still high, but inflation starts rising again, maybe due to global tensions, supply shocks, or energy prices. Now central banks are stuck. They can't raise rates too much because it could crash the economy, and they can't cut rates because inflation is still high. This is what experts call a trapped environment. And historically, gold performs very well in such situations. Because when trust in the system starts to weaken, investors look for something real, something that has held value for thousands of years, and that's gold. Now let's bring this back to you, as a viewer, as someone trying to understand what to do next. The biggest mistake people make is reacting emotionally. When gold drops, they panic. When gold rises, they chase. But the real opportunity is in understanding the cycle. When interest rates rise and gold falls, it doesn't always mean gold is finished. Sometimes it means gold is preparing. And when rates start to peak and uncertainty grows, that's when you need to pay attention. Because the biggest moves often happen when most people are confused. Now think about this. If tomorrow headlines start saying central bank may cut rates, what do you think will happen? Markets will react instantly. Money will move, and gold could start rising before most people even realize what's happening. That's why timing and understanding matters so much. And that's exactly what we do here on the Gold Report. We connect the dots, so you're not just reacting, you're thinking ahead. Now, as we move toward the end, I want you to think about your own view. Do you believe interest rates will stay high for a long time? Or do you think the economy will force central banks to cut rates? Because your answer to that question is your view on gold. If rates stay high and inflation falls, gold might stay under pressure. But if rates peak and uncertainty rises, gold could surprise a lot of people. And sometimes the biggest opportunities come when the majority is looking the other way. So if you found this video valuable, don't just watch and leave. Drop your opinion in the comments. Do you think gold is going up or down from here? I read every comment, and it helps everyone learn from each other. Also, share this video with someone who is interested in gold or investing, because one idea can change someone's financial future. And if you want more deep, simple, and powerful breakdowns like this, make sure you subscribe to the Gold Report, because the next move in gold might come faster than most people expect. And when it does, you'll want to be ready.